Gold is seeing its worst monthly decline in nearly 3 years as prices dropped more than $100 in November, reacting to a strong U.S. dollar and higher bond yields. So what now for the metal? Frank Holmes, CEO of U.S. Global Investors, joins us now on Kitco's Gold Report. Frank, good to see you.
It's good to see you. And yes, it's brutal for 20 days and also brutal for 60 days. But that brutalness, that feeling of pain and bruising is probably getting ready for a great trade because it's crowded in shorting gold right now.
Yeah, well,
when we look at gold over 20 trading days, it's down 2 standard deviations. And when we look over 3 months or 60 trading days, it's almost down 2 standard deviations. So odds favor mathematically a rally in the next 20 days by year end from these lows. And that's where I stay bullish for the traders.
Well, as we're speaking, Frank, gold's down about 1.3% on the day. So I think you alluded to it. Is this just a case of, this too shall pass for gold? UBS earlier saying that the downside for gold from here should now be relatively contained.
Yeah, I think so. It's because these standard deviation moves. They're very mathematical. They only move X% over Y days, and then you get a mean reversion. And I think if you get a 5-day high here in the price of gold or a 10-day high, it will trigger all this short covering and we'll get a rally. Most likely we have to wait until the interest rate scenario rise.
But Frank, is there another story at play here? Investors pulled out more than $2 billion from the biggest ETF backed by gold since the end of October. Holdings in ETFs are heading for the biggest monthly drop in nearly 3 years. So could this be ETF fueled here?
Well, I think that's important to recognize is that Trump coming into power is dropping taxation, streamlining regulations. And I think this is very important because you've seen that huge shift in capital markets. I mentioned last time $1 billion went into tips, gold went off. So people are buying these short-term tax-protected bonds. So there is a shift going on the threat of rates rising. But mathematically also, rates have had a massive surge on the 10-year, and they still have negative rates. So I think that we're getting for an inflection point for gold to get a rally.
So what is an investor to do here? Credit Suisse says investors should consider a long-short play, being overweight Japan and underweight gold. What do you make of this call? How would you position yourself here, Frank?
That's something for that esoteric trader that has skills I don't have. But I do think for that person who's trading gold in U.S. dollars or in Canada and Canadian dollars, you do get this volatility, and this is for the trade. Look for the 10-day high in gold, and then you will see that short covering take place.
All right, Frank, to wrap, we have lots of events coming up. We've got jobs, we've got the Italian referendum. So what's your touchdown pass going to be this week?
I think it's the last unemployment number coming out before interest rates rising. And I think we're going to get into that scenario like last year. After interest rates rise, gold rises.
Frank, thank you so much. Thanks for joining us. And thank you for watching. We'll see you tomorrow on Kitco's Gold Report.